selling put options in a bear market is what we will be discussing in this video, because this channel is all about trading stock options. And because stock options are a derivative of the stock market, this channel is indirectly about the stock market. In this video, I'm gonna give you a beginning way to look at selling put options in a bear market. And throughout this video, there will be little freebies sprinkled in. So watch this whole video. Once this video is complete, you'll have different things to go to help this journey of selling put options in a bear market. And if this type of information is interesting to you, consider going to that subscribe button and do the clickster on it. Now let's get into selling put options in a bear market. First of all, what are put options? Right. Put options are derivative contracts. What's a derivative? A derivative is something that obtains something from something. So a stock option is obtaining its value from a stock. So the stock option is a derivative of the stock. Thus, put options are derivative contracts. A put option gives the buyer the right to sell stock at a predetermined price, called the strike price, for a specific period of time, called the expiration date. Because the put option derives its value from the underlying stock, options are known as derivatives. The buyer pays money to the seller, called a premium, for the seller's obligation in this. Since you will be selling the put option, you are going to be receiving that premium. Put options are basically stock insurance, which means you can acquire stock by underwriting them. In order for the buyer of the put option to sell stock at a predetermined price, which we talked about, it's called a strike price, for a specific period of time, which we talked about, it's called expiration date, someone needs to buy the stock. That someone is the put option seller. When you sell a put option, you have the obligation to buy the stock at the strike price on or before the expiration date. Generally, you will buy the stock if the market price of the stock is below the strike price at expiration date. Attention! Cash secured put versus naked put. Right? Selling a put option is a commitment to purchase stock. Stock options are in 100 share increments. That means one put option equals 100 shares of stock. So choose stocks you can buy at least 100 shares of. When you sell a put option that you do not have the money to fulfill the obligation, you're selling a naked put. This is a much riskier proposition. In fact, everything going forward in this video will be obsolete, null and void, whatever term. Everything in this going forward in this video will basically be disregarded if you're selling naked put options. Now, I'm going to be honest, I have sold naked put options. I probably will continue to sell naked put options in the future. However, that's not what this video is about. And for the record, I have sold way more cash secured put options, and I will continue to sell way more cash secured put options. And the reasons why I'll be explaining in this video. So for this video, for a beginner, helping you begin your trading journey, you need to select stocks that you can buy at least 100 shares of. So you'll be selling cash secured put options. Now we're selling cash secured put options in a bear market. So what is this bear market? Well, did you notice everything on the screen was going down? That's what a bear market is, when it's going down. Per Investopedia, what are the takeaways of a bear market? Bear markets occur when prices are in a decline by more than 20%, often accompanied by negative investor sentiment and declining economic prospects. Bear markets can be cyclical or long-term. The former lasts several weeks or a couple of months. The latter can last several years or even decades. So let's get rid of this technical mumbo jumbo here. When you see this, that's a bear market. When you see this, that's a bear market, or bear trend, bear whatever. That's going down, right? So let's keep it real simple. We don't need to go on CNBC and talk about fancy definitions and all these type of things. We need to make money. That's it, right? We don't get A's on report cards for giving the proper technical definition. We make money for making proper decisions. So bear market, bear trend, going down. The bear goes down. And if you learn how to trade the bear market, you're going to be enjoying that sweet honey that the bear can bring you. So here's a chart of the S&P 500 going back to 1992, if you can see that very well. And when these color differentiations here, those are 1 year periods, right? So we see a bear market here, and we see that it kind of started towards the kind of the mid or kind of like the ending of the mid, let's just say mid 2000. Lasted all of 2001, lasted into 2002, and sort of kind of in beginning of 2003 started trending up. And you notice during this bear market, right, which you see overall the prices down, but you notice this down, but look at this, it went up right here, down, look at this, it went up right here. So in the midst of a bear market, you can have prices going up for a little while. Here's another one right here that lasted a little over a year, right? Started sort of the end of 2007 and looks like it kind of hit the reverse around the beginning of 2009. Same thing, during this bear market, prices went up. So that's what's going to happen. It's going to be this ebb and flow. Even here, we had like a little bear correction, right? And now let's look at where we are today, right? Per when this picture was taken. And so this is where we are. End of 2021, beginning of 2022, this bear market started, and we're almost getting close to a year in this. But you can see that there's been, in this bear market, here's a time where prices went quite a bit up, right? So there's going to be times, right, in these bear markets where prices are moving to the upside. Just like in this bull trend that you see right here, bull market, there were times when prices dropped down. So we want to learn how to trade both ways. And the other thing that we really need to take from this chart is that whatever trend that it's in, bull or bear, first thing we want to take away, it can last a long time. Second thing we want to take away is that prices can move in the opposite direction while it's in a bigger trend of which side. So in this case, bear markets can last for several years, possibly 1 year, several years, and also prices can be moving up while still in an overall decline, as we see here. Trend down, prices move up. Selling put options in a bear market considerations. Number one consideration, if you're not comfortable, paper trade. What is paper trading? Per Investopedia, paper trading is also known as simulated trading, which allows you to trade fake money and practice buying and selling securities. Everything is essentially the same as if you were trading with real money, except you can practice your hand at trading without any of the risk. Now, there's certain people that will poo-poo paper trading, and they poo-poo it because they say you don't get the real emotion, and that's true. You don't get the real emotion. But let's take this idea of training, right? Practicing something without getting the real emotion. How about flying airplanes? If you wanted to learn how to fly an airplane, would you consider getting in a flight simulator? Not a real airplane, but like a virtual airplane. So all the controls would be the same. Maybe it even leans back a little bit. It's going to simulate flying. Would you consider doing that? Even though it doesn't give you all the real emotion, do you think that there still might be some value of training yourself to learn how to fly with a simulated experience of a fake airplane? Possibly. How about this? Let's say if you wanted to learn how to box, would you consider punching a bag? There's not the real emotion when you punch a bag. However, you can work on your technique. If you wanted to learn how to box, would you consider sparring with an opponent, wearing headgear, wearing boxing gloves? Would you consider doing that? Now, there's not the real emotion of a fight or a match, right? A boxing match. There's not that real emotion there. But do you see how training without necessarily the full emotion, to make sure that you have the fundamentals, to make sure you kind of know what you're doing in a controlled environment, can have some value, so that way you're not risking everything. Hopefully you can see that. Another consideration, when you're selling puts in a bear market, consider thinking about buying assets versus making money. This is going to come into play. This concept is going to come into play all throughout this video. It's going to end up being pretty important, because part of this particular strategy that I'm going to show you puts you in a position where your worst case scenario is you're buying an asset. Think about that for a second. If your worst case scenario would be that you're buying an asset, that's a relatively good scenario, right? So consider, when you're selling put options in a bear market, consider thinking along the lines of buying assets versus making money. If you're able to change your mental framework, then this ends up becoming pretty smooth, and trust me, you will make money. You absolutely will. Now, another thing that I want you to consider is to consider choosing stocks that you would be comfortable owning the rest of your life. As I mentioned in the slide before, is that your worst case scenario would be buying an asset. So what are the assets that we're talking about? We're talking about paper assets, specifically equities, stocks. So choose stocks that you would feel comfortable owning the rest of your life, just in case you had to, right? Now, in the description of this video, there is a link to a place where you can download a guide to help you do that. However, keep watching this full video, because there's another thing I want to share with you. Of course, I want to share with you the whole video, but there's another link that I want to share with you further on in this video. So at the end of this video, go to that link in the description, download that guide, go through it, so you have an idea of how to format your decision-making process in order to select stocks to sell cash-secured put options on. The fourth thing I want to talk to you about, to consider, is consider being the tortoise, not the hare. Are you familiar with the story, the tortoise and the hare? The hare moves much, much faster, but the tortoise ends up winning the race. Slow and steady, slow and steady, slow and steady. Especially if you're a beginner, slow and steady. Be the tortoise. Trust me, you will make money if you're the tortoise. If you stick with things, you do things properly, you control the things that you can control, which is basically mitigating your risk, you're going to end up making money. But focus on buying assets, be the tortoise. Now, let's look at setting up some stock charts to help you in this process. Some people trade options without using charts. I am not that some people. I'm in the some people camp that uses charts. I love reading stock charts. I think it's fantastic. And I'm going to help you have a basic setup to be reading, to help you start in the process of reading these stock charts and use it to your advantage of selling put options in a bear market. So the first thing we're going to do is you have to have a stock brokerage. That's the first thing that you need. So I have maybe 4. I really only use 2, with mainly using 1. But use whatever one that you particularly like. These charts happen to come out of Tastyworks. Tastyworks is the one that I use. I don't necessarily use it the most. I just particularly like the charts on there. I'm not suggesting that you should use Tastyworks, but look around, find the right brokerage for you. And as I mentioned, these charts happen to be from Tastyworks. So some things, as we're talking about setting up these charts, some things will be similar as far as where to access things. Some things might be a little different. Nonetheless, you just got to click around and you got to find it. But overall, there's going to be some similarities. So the first thing we're going to do is set up some indicators. The first indicators we're going to set up are these lines right here. These are moving averages. This is a 200-day moving average, this is a 50-day moving average, and this is a 20-day moving average. So a moving average, these are simple moving averages. You want to use exponential, you want to use simple, you want to use whatever, try whatever you like. I like using a simple moving average. Now these moving averages, like for the 200-day moving averages, it's basically taking the close of the last 200 days, adding it up, and then dividing it by 200, and then plotting it on this line here. Same thing with the 50, same thing with the 200, excuse me, the 20. Now the 200-day moving average is giving us a snapshot of what this big overall 200-day trend has been, right? So this 200-day trend we see has been going up on the slow incline. This 50-day, this is kind of a medium, mid-trend, medium trend, and we see the same thing. It's been going up. The 20-day is more of a short-term trend. Now you could use an even shorter-term trend. Some people use like a 5-day, a 7-day, a 9-day, a 13-day, 3-day, whatever. You can use whatever you want. These are the 3 that I particularly like, and at minimum, you definitely want to know what the 200-day moving average is, and probably the 50. But another thing we want to know, we want to understand about not only these moving averages, but indicators in general. Most of the time, these indicators are lagging indicators, which means it's basically old data, right? What's a current indicator? I'll tell you what, the current price, that's a current indicator. And these other indicators, they're generally lagging indicators. So just keep that in mind, right? You're using these indicators to help make a decision, but realize that it's just help make a decision, right? It's not the decision. The other thing about moving averages is they are not support and resistance. Now they can act as support and resistance. They can, but they're not, right? There is definitely a difference, and you have to understand, you don't have to, it would behoove you to understand that difference, that they can act as support and resistance, but they're not guaranteed support and resistance. So one reason why you'd probably want to use a 200-day moving average is because that's like definitely, if there's only one that everybody looks at, it's the 200-day moving average, probably followed by that 50-day moving average. Where would you find it? Well, in Tastyworks, you're going to find it here under indicators. I think Thinkorswim calls it studies. in different, I've seen one particular brokerage that didn't even have charts. So if you don't have stock charts in your brokerage, then if I were you, I would get one that does. So you might have to click around. It might be called something, different studies, indicators. I don't know, whatever it might be. But more than likely, you're going to find them. Now, the next thing we're going to do is we're going to put on some sort of MACD or stochastics to help gauge trend. A lot of people use a MACD. When I first learned how to read stock charts, I was shown the stochastics, so I kind of use both. I'm not really partial to either. There's different ways you can set up your MACD, and there's various forms of stochastics. Fast stochastics, slow stochastics, full stochastics. I generally use like full or slow stochastics if I'm setting it up myself, but you can play with it, see what you like. Again, remember, these are lagging indicators. And so this is showing us this big trend. So here's a MACD. And you notice there's some numbers along here. You're going to notice there's these lines here, which I'm not the best at. I don't really know. I just basically looking at this line. I think this might be volume or momentum. But I'm looking at these lines, and I'm seeing that the red line crossed over the blue line here. What direction is it going? It's kind of going up. When it's getting into this area, this top range, people consider that overbought. What's in the bottom range, they would consider that oversold. I don't particularly look at it that way so much because it can stay oversold or overbought for quite a while. But I'm knowing that it's this oscillating thing, and me personally, what I'm really looking at this for is I want to see the trend. Like, see, here's uptrend. What do I see right now? Downtrend. How far apart are these two lines? They're pretty far apart. What's the angle that they're going down? That's going down at pretty good. Versus, look at this, sideways, right? Even though the red was under the blue, look at that, sideways, really weak trend. So play with them, test them out. Where would you find it? Same thing. Under indicators, under the same place wherever you found the moving averages. Now, we're going to start off by looking at the monthly chart. How do we know it's well, first of all, what is a monthly chart? Now, right now we're looking at Japanese candlesticks, and each one of these candles represents 1 month of time. Where do we find that at? Right here. Right there. M for monthly. Now, what does this mean? It means that with one glance, I know that let's say our most current month, it opened here and it closed here. When it's red, I know it closed lower than it opened. When it's green, I know it closed higher than it opened. I know it opened here. I know it closed here. I know it traded as far as down here. I know it opened here. I know it closed here. I know it traded all the way up there because there's that skinny line, and I know it traded just a little bit down here. So we're looking at this monthly chart, right, with a Japanese candlestick. Why the monthly? Because we want to see what's the biggest trend, right? Could you look at a yearly chart? Yeah, but I think a monthly is going to be fine. And a lot of charts might not even have yearly or quarterly. So look at a monthly. Trust me, that'll probably be enough. So we start by looking at the monthly. And what do we see? Well, first of all, we see our MACD. All right, it's red under blue or whatever, these. Usually it's red. It can be yellow. It can be whatever color. Don't get thrown off by the color of the line too much. But we know this particular, it's red under blue. It's got a pretty wide gap, and it's going down at a decent pace, right? It's kind of in the middle of going down. So that tells me we're in a downward trend. That's what I see here. I see in a downward trend. High, lower high, lower high, lower high. I see that our price action right now has crossed over the 200 of the 20-day moving average. It's trading below the 20-day moving average. It poked up against the 20-day moving average, but got rejected. And it would look like, wait, what do I see here? I see that this month was a down month. This month, prices rallied up, but couldn't close higher than where it initially opened. The next month, it opened here a little bit lower than where it closed, tried to trade all the way up there, but got rejected, and it closed halfway into this candle. The following month, it opened up in the bottom part of this candle. So it's just showing me this basically all this buying was wiped out. So my big picture trend of what I'm looking at is showing me I'm in a downward market, but kind of the beginning on a monthly chart, the beginning of a downward market, because I'm still above that 50-day moving average. I'm testing more of the 20-day moving average than testing the 50, although I potentially have more ways to go. So the next thing we're going to do is we're going to look at the weekly chart. Guess where you find out if it's weekly? Same place you changed it. You selected monthly, then you select weekly. Now what do we see here? That's the same. It's the same chart, the same indicators, but now instead of looking at this bigger candle that represents 4 weeks, we're looking at those 4 weeks individually, right? So here's a week, here's a week, here's a week, here's a week. That's 1 month. Maybe when I took the snapshot, maybe that's 1 month or whatever. But nonetheless, hopefully you get the picture. So what does this tell us here? Okay, we see on our MACD, we see that it had been going down. It rallied up a little bit, but that uptrend is kind of short-lived. Now it looks like it's possible for red to be crossing under blue and continuing that downtrend. What do we see when we look here? We see that prices have been going down. Our little bump here was probably right there. What is this? This one? We see that that 20-day moving average crossed through the 50-day moving average. We see that our price action is below the 20-day moving average, below the 50-day moving average, and it's our 50 days starting to turn over. And we see going back to here to basically the beginning of 2000, looks like the beginning of 2022. Prices went down, rallied up, went over that 50-day moving average, but couldn't maintain over it, went down, rallied up, went over the 20-day, tried to test that 50-day, but couldn't do it, dropped down. And here we got kind of close to the 200-day moving average. And if things keep going this way, we will be testing this 200-day moving average. However, at the moment of this picture on this chart, at the moment of this picture being taken, we're still above that 200-day moving average. So what does this tell me? It tells me we're in a downward trend, but we're kind of rallying up, which is basically showing me more detail of what I just looked at in the monthly. And then we're going to go to the daily chart to make our decision. Guess how you select the daily chart. Right here, just like you changed it from monthly to weekly, now we're at daily. And what are we seeing in the daily? Okay, we see it's been in this downward trend on the MACD. We see that all our price action is below the 200-day, below the 50, below the 20. We see that downward. We see going back over here. It's just been broke through the 200-day moving average. And basically, once it's below the 200 or once it's above the 200, it tends to stay on that side. Like it takes a lot of momentum to cross through there. And we see that that's what's been going on. It tested here, bounced above, broke through the 200-day moving average, broke through the 50-day moving average. All these moving averages crossed over. See, it's been in this downward trend, rallying up, back and forth. So that's how you would set up your stock charts. And obviously, now when we're looking at this, we're looking at 30 days in a month, right? Now we're peeling back that weekly. We started by looking at the full trading day, about a full trading month, about 30 days in 1 month of that candle. And then we opened that candle up and we looked at the 4 different weeks inside of that. Now we're opening up these individual candles and we're seeing all the trading days inside of there. And we're using this one to make our decision. And we want to recognize when all 3 time frames are in alignment. So right now, the monthly's definitely been moving down. The daily's definitely been moving down. That weekly, it started moving up. Now it's getting ready to tip over, right? So when all 3 are in alignment, you're going to have potentially could have a powerful move to whatever direction that is. This obviously is not a full course on reading charts, but hopefully that it definitely should give you an idea of how to set them up and a little bit of an idea of how to work with it. We'll look a little more at this further on in the video. We'll look a little bit at how to actually use the chart to better gauge when to sell your put option and what to do afterwards. But this is how you can set it up in an idea of how to look from top down, looking at multiple time frames. And then let's look at opening an order. You use the daily chart to decide what strike price. What was the strike price? That is the price that the stock is, the predetermined price, right? That someone could sell their stock at. So you use your daily chart to determine what strike price you want to sell at. You use your daily chart to determine what was the other thing? The time frame, that predetermined time frame, the expiration period. Now, when you sell a put option, you're selling to open the position, right? You're going to sell to open. And you're going to do this with a limit order. A limit order, limit orders fill your order with the price that you want or better. So that means if you set up a limit order and you're not getting that price, your position will not be opened, right? So you're guaranteed you're going to get this price or better, or it's not going to open. So we're going to sell to open the position with a limit order. Now, some considerations. Purchasing stock that drops in price is a risk of selling put options. So what do I mean by that? I mean that if you sell a put option that has a strike price of, let's say, $10, and the stock goes at $8, you're buying 100 shares minimum at $10 for an asset that's now at $8, and we're in a bear market, so it could keep dropping. Now you just paid $10 for something that's valued in the marketplace at $8 and potentially could keep dropping. So again, you need to be okay with owning the stock regardless of the market price as a worst case scenario, right? You need to be okay with owning the stock at a price that is regardless of the market price, and that is your worst case scenario. Your absolute worst case scenario is if the business goes bankrupt, the price goes to zero. But that, by selecting a good stock, you shouldn't run into that. So the most common thing that would happen in this sort of bear market would be you're buying a stock at, let's say, $10, it drops down to $8, you're forced to buy it at 10 because you wrote the put option at 10, and then the stock is trading at 8, 7, 6, right? That would kind of be your worst case scenario. And the other part, like we talked about, get in the mind frame of owning an asset, right? Because now you're owning an income producing asset, and that's better than losing money, right? So what's your worst case scenario? Your worst case scenario is that the company goes bankrupt, but you're going to use the put option selection guide, so that's not going to happen to you. You're going to pick a good stock, it's not going bankrupt. So your more feasible worst case scenario is the market price is trading lower than the strike price that you bought the stock at. And that is a better situation to be in, because now you own an asset. Yeah, I get it. You own an asset that you can't sell for the same price you bought it at. But if you chose a good stock, it's producing a dividend for you. Now it's an income producing asset, and you're going to learn something about selling covered calls. So this can be making you money. Trust me, this is a much better situation than losing money. Owning an asset that produces income, losing money. Which one would you rather do? Some other considerations. So in order to try to buy, if you have to buy the stock, in order to get the best price, consider selling shorter expiration periods. The shorter the time frame, the more accurate you can be at looking at the charts and having an idea of where the stock might go or where the stock might not go. It's just way easier to potentially predict the future when you're looking at shorter time frames. So consider shorter expiration periods. Consider selling further out of the money. So if the stock's currently trading around 10, see if you can sell the put option for 6, even though you're going to make less money, right? But we're going back to that other slide. Our mindset is going to be thinking about acquiring assets versus making money. As you get closer, if you were to sell that put option at $9 when the stock is trading at 10, you're going to make more money, right? But consider shorter time frame and further out of the money. That way, because since you're in a bear market, if it drops, right? If it drops from 10 down to 7, you're at 6, right? Or if it drops from 10 down to 6, right? You're not buying it at 9, even though you would have quote unquote made more money in the beginning. Selling shorter time frames, selling further out of the money. And as I was discussing, be okay with making less money on premium. You're going to make more premium for selling the put option at $9 than if you sell it at 6. Just be okay. Be okay with it. Remember, you're the tortoise. Be the tortoise, not the hare. You're going to end up making money. Towards the end of this video, I'm going to show you something that one of my friends, when I showed it to him, he couldn't believe it. It literally blew his mind. He told me this has to be illegal. It's not illegal, but it is mind-blowing that it blew his mind. He couldn't comprehend it. Thought it would have to be illegal. So trust me, I'll show you how you end up making money. And the other thing to consider, sell to open on a down day. When the stock is moving down, you're going to get better premium. So sell to open on down days. Then you can go even further away from the money. If the stock is going up, you're not going to get as much premium. So sell on those down days. Now the closing order. Okay. Now we sold to open, and now we're going to set in an order buy to close, right? We sold to open. Now we're going to set a limit order to buy to close. And when you sell to open, you buy to close. You're going to the limit orders, as we discussed, fill your order with the price that you want or better. And you're going to enter this closing order, buy to close. You're going to enter that as a GTC, good till canceled, the same day you open the position. Right? So now let's say in our same scenario, the stock is trading around 10. It has like a down day. You sell at $6 at a $6 strike price. Because it went down for some reason, normally there's not any premium at the $6 strike price, but because the stock went down, you were able to sell get a couple bucks. Let's say you got $4 at the $6 strike price. Once you're filled on that, now your position is open. You're going to enter a closing order, buy to close, with a limit order. Let's say you brought in what I say, $4. So maybe then you're going to be okay with making a little bit of money. Now you're going to sell to close at $2. You brought in 4. You're selling to close at 2. What's 4 minus 2? 2. So you made $2. Minus some commission. So you made a little less than $2. But remember, you're the tortoise. Also, consider closing the position with a small profit if the stock rallies. That's just what I was talking about. You brought in $4. You brought in 4. So obviously you have to close it for, like, if you close it for $3, you'll close out fast, but you're only making $1 minus commissions, right? So you're really not making much. So you can kind of you kind of play with it. But what will end up happening is you're going to be okay with taking a small profit if the stock rallies. Now remember when we looked at that chart where the stock's moving down, but there's times when it rallies up, right? So consider doing that. In fact, we're going to look at a chart in a moment to give us a better idea of that. And why do this? Because you can always resell a put option at a lower price if needed after. Again, your worst case scenario is that you're going to own an asset if your closing order, you might own an asset if your closing order does not get filled. So here is a chart of the S&P 500, and it's a daily chart. We see that S&P 500 is below the 200-day moving average, below the 50-day moving average, and this happens to be a 25-day moving average, and it's below that. What you see here, let's take a closer look at from about right here going forward. So S&P, it dropped down here. Now let's say you sold some put options down here. When it rallied up, right, you could potentially close out that position. You set in the good till closed order. You opened your position. It got filled. It starts going up, and as it moves up, the put option loses value. So you sold it with a $4 premium. Now you're able to buy back that same position for $2, keeping $2. Same thing kind of happens here, right? It drops down, rallies up a little bit. Here's a better example, drops down. Let's say you sold a put option down here. It rallies up for 1 day. If you're okay with taking a small profit, it could potentially close you out here, and then you could resell when it drops down here. How do you place these orders? You're going to place them on the option chain. So this is an option chain, and down the center here, and this is on Tastyworks. They might look a little different on Thinkorswim or TD Ameritrade or Webull, wherever you're at. It might look a little different, but it's generally the same. Down the center, we see right now it says strike, but that is covered up because we're looking at all these dates. So these down the center, these are how many days till expiration: 1 day till expiration, 3 days till expiration, 5 days, right? And this is the actual date corresponding with it. And this is the asset. This happens to be a picture of NASDAQ futures, and that's why it's this /NQ stuff. And now let's open this up, right? So we see the big picture here, and let's take a look at a 5-day time period, because we talked about consider selling in shorter time frames. So let's look at 5-day time period. But I just happened to realize I was looking at the futures before, so I changed it to the S&P 500. So now we're looking at the put side, right? This is a smaller snapshot. Before, our strike price, right, and our date was down the center, and we had puts on one side, we had calls on the other side. Even though I didn't explain that, that was on the left-hand side. Now we're just looking at the right-hand side, puts. You see bid and ask. Bid is the price that you sell at, ask is the price that you buy at, and you can always remember that because you're going to sell at the lower price, going to buy at the higher price. That's just how it is. So we got expiration date of 5 days. These are the different strike prices. This is where the stock is trading. As you go down, it gets higher, right? 343, 361. So you were looking at your charts and you realized that you wanted to sell a strike price of 350, which means, what does that mean? It means that you are selling the commitment to buy 100 shares of S&P 500 at $350 a share. So you would need $350 times $100 in your bank account to be selling cash secured put option. If you don't have that money in your, I said in your bank account, in your brokerage account, then you'd be selling a naked put option, which totally disregards buying the asset, right? So you're going to select a stock that you can buy 100 shares of. So in this scenario, you have enough money to buy 100 shares of SPY at this amount, and you're going to be getting $2.56 times 100. So 256 bucks. Not too bad, right? For 5 days, assuming you got filled and assuming that you had all that money to write this contract. So that's how you'd open it. You'd click on this and you'd go through a little some other stuff, which every brokerage is a little bit different. But this is where you'd find that information. Now we talked about we talked about what happens after you open the position, right? You open the position. You opened it, in this case on the S&P 500, you got paid 356, was it 356 bucks? Something like that, about 356 bucks to for that 5-day commitment. And let's say you put a good till canceled order, GTC, to close that position, and you're okay with just making 20 bucks. So you sold it for, let's just say 350, and then let's say you're okay with buying it back at 325, being that you'd make $25 if the stock rallies up a little bit for whatever reason, right? So you do that. But let's say the stock drops. It doesn't rally up. It doesn't allow you to close it. That means you will get assigned, if at the end of 5 days, if the S&P 500 is below your strike price of 350, that means you buy 100 shares of S&P 500 or whatever stock. So what happens if you get assigned? And assignment means you fulfill the obligation. Well, at that point, you're going to consider selling covered call options. In fact, right here, there's going to be a video popping up that's going to help you sell covered call options. So once this video is over, remember the time that this is at. After you download your free stuff, watch that video when you're ready. Another thing to consider is realize that you can now buy stock insurance with a put option also. You were just selling the put option. Now you can buy a put option. You have 100 shares, you can insure your stock. You could be the one paying the premium to someone else saying that, hey, I want to be guaranteed. I just bought S&P 500 at $350 per share. I don't want to lose more than whatever, 50 bucks. So you could buy a put option. You could buy a put option like you were just selling. You could buy one at, like, let's say $300. So if S&P 500 falls down to 200, you're able to sell your 100 shares to somebody in the market at 300. The other thing is that you used the put option, the cash secured put option selection guide that I'm allowing you to download for free. You use that, which the link to is in the description of this video. You use that, you picked a good stock, it gives you dividends. Now you're collecting dividends, you're selling covered calls because you're going to watch that video, you know how to sell covered calls, and you were okay with owning this asset the rest of your life. And then you can start enjoying reducing your cost basis. Now, what does that mean? Let's take a look at this. Unfortunately, at the moment, I cannot give you this for free, but I'm working on it. I'm working on it. So download whatever I have for you right now. So that way, when I do have this for you, you will be emailed it. You won't even have to ask for it. This works wonders, and I'll show you what it is. So this basically is going to give us what our cost basis is. What is a cost basis? It's how much you paid for an asset. And right here, this is really important. This is what blew my friend's mind, and he thought had to be illegal. Cost basis of 0 equals infinite return on investment. Normally, you hear people talking about ROI, return on investment. They're like, I'm getting whatever, 20% ROI. I'm getting this, I'm getting that. What about an infinite return? It is possible. And let's take a look at this. Right, so we're using this, right? We have the ticker symbol. When we sell stock, it goes in this column. When we buy stock, it goes in this column. And when we receive any type of credit from selling options, from dividends, it's going to go in this column. This is going to show us whatever profit or loss that we have with that correlating ticker. So let's take a look. With our pretend stock of ABC. Now let's say you sell a cash secured put option on ABC stock, and you bring in a whopping $4 premium. but you were using Thinkorswim, and Thinkorswim charges you a 66 cents fee on every one option you sell. So $4 minus 66 cents is $3.34. Now we look over here, ABC, $3.34. Now that contract expires, it expires worthless. So what does that mean? It means that whatever strike price you sold at, ABC traded above that during expiration, you kept the premium, the other person kept the stock. Let's say that was 5 days, okay? 5 days, and then 5 days go by, you keep the premium, and then you do the same thing. Now, this time, you sold on a down day, and the volatility was high, and you took in, this time, $6. Wow! Instead of $4, you got an extra $2. Minus that 66 cent commission, you pocket $5.34 on the second time you sold the cash secured put option, which means now you've took in a total of $8.68 from ABC without owning the stock yet, just from selling promises. Now, on this time, when you sell it, when you sold this put option, ABC dropped below the strike price, which your strike price was $8. And what did that mean? That means you had to buy 100 shares of ABC at $8, which you did. And now, over here, it starts calculating our cost basis. Now you bought ABC 100 shares at $8. So you would think your cost basis is $8, right? But look at this. $8 minus $3.34 minus $5.34. Now it's obviously it's $8 times 100 shares. So this is calculating it, and ultimately right now your cost basis is actually a little less than $8. It's $7.91. Now let's say more time goes by. Now you're selling covered call options on ABC, which I told you there was that link, and there was that link back there. In fact, at the total end of this video, there'll be another link to it. Now you're selling covered call options. You sell a covered call option for 5 days, you bring in $4 minus your 66 cents, $3.34. 5 days goes by, it expires worthless. That means the ABC was trading below the strike price you sold the covered call. Watch that video to explain more. You sell it again. 5 days later, you do it again, but this time you only bring in $2 minus your 66 cents. Look what happened to your cost basis, right? You bought it for $8 originally. Now you see how your cost basis is creeping down? Now, when you originally bought it, your original investment of $8 times 100 shares, right? Minus this credit equals $7.91 and some change per share. Look at this, $7.91. You sell these covered calls. Now your cost basis is at $7.83. Now, hopefully you can start seeing the value of selling put options on a stock you'd be okay with owning the rest of your life, acquiring assets that you're okay with owning the rest of your life. Because now you see, sooner or later you're collecting dividends. You collect a dividend, it lowers this cost basis down a little bit. You sell another covered call option, it lowers this cost basis down a little bit. What happens after? Might take a couple years, but what happened? Remember, you're the tortoise, though. You're the tortoise, so you're okay with taking a couple years. I told you you're going to make money. What happens when this cost basis eventually is at zero? What happens over time of collecting dividends and selling covered call options? What happens when you have pulled $8 out? I'll tell you what happens. You have $800 in your pocket. You have 100 shares of stock. You have a cost basis of zero, and Robert Kiyosaki is going to give you a high five because you have an infinite return on your investment. That, if you structure things properly, this is what can happen in a downward market. You can be in a position where your worst case scenario is not losing money. You can be in a position where your worst case scenario is you have a long-term golden goose laying golden eggs for you. Again, practice with paper trading. I gave you a lot of information. Practice with paper trading. What is paper trading? Paper trading is simulated trading using this fake money. Practice with paper trading. Even if you're doing the real thing, still practice with paper trading. Also, I got the selection guide for that stock. Go. You got two ways you can do it. You can check the description below. There'll be a link. It's a link to ihavesuccess.com. You can download that cash secured put stock selection guide. There's 3 other downloads you can do. And then when I get the cost basis spreadsheet into a position where I can share it with you easily, it's going to automatically be emailed to you. And somewhere popping up will be a link to the video of selling covered call options. A lot of information. Consider watching another time and reach out with any questions in the comments to me. You guys have a fantastic day. Aloha.